lot of quite advanced automation and risk analytics IP, and so the other part of our business, Carrington Labs, offers that on a SaaS basis to offshore lenders. And we went public in January 2022.
Hi everybody, my name's Karan Anand. I'm the Chief Strategy Officer and the Australian Managing Director for Henry. We're an accounting service and tax automation tool for sole traders, and we operate across Australia and New Zealand. And the principal problem we solve is when you're switching from a salary employed owner to a self-employed owner, tax becomes your responsibility. So we provision each of our customers with a Henry account, which automatically calculates and deducts all their taxes for them. We provide them with an accounting software through the Henry app, available on the App Store or the Play Store if you're interested. And then we also act as a tax accountant. So we're about 7 years old in New Zealand, about 3.5 years old in Australia. We are privately funded, venture-backed, bigger shareholder sitting to the left of me, and we'll talk about that journey shortly as well.
Hi everyone, Justin Lippman, partner at EVP. We're a B2B software-focused venture capital firm from Sydney. We have about 750 million of assets under management, and my part-time role is as director of Henry, as Karen mentioned, which I think gives me the right to be on the stage.
Awesome. So we're really looking at to IPO or not to IPO. That is the question. Jamie, you guys have IPO'd and have had a bit of a roller coaster.
And it was the best. You're going to love it.
Roller coaster of a journey. So we'd love to hear from you about that journey, and it'd be great if you can be as vulnerable as you feel comfortable with in going through the difficulties you guys have had in that journey.
Sure. So my mother never hugged me as a child, and so I joined as CEO in May of 2021, and the company was still quite new. We'd only had our commercial launch in August of 2020, so it was still quite a young company to go public. And there were various reasons, some were related to where the market was at. As you remember, it was quite a boom time for fintechs, and there are a lot of very happy IPO stories, and some idiosyncratic reasons related to just the nature of our company and where our funding had come from and on what terms. And so I'd say the first thing I'd say is that the IPO process itself, at least in our experience, isn't that bad. I sometimes describe it like planning a wedding. There's a long list of things to do, and you just go through the list and you do them all. The thing that's hard is getting the company in a state where it's ready for that, because there are things that you would need to do over a period of years as the company matures, and you are now going to do them all at once in a fairly compressed period of time. So just routine stuff like cleaning up your contracts and making sure that kind of you've got a very clear view of your register and that's documented, and getting audited financials back to the founder and all that sort of stuff. And you always kind of find a few things, you look under a few rocks and there's some things that are a little more difficult than you thought. So that was there's a lot to do for that. The actual process itself just sort of is what it is. Then we rang the bell in January of 2022 at the ASX. The bell actually broke while we were ringing it, which maybe that was a sign. Maybe that was the thing that actually kind of turned the whole market then. But there was as many of you would remember, there was a very significant change in the markets, I think both private and public, but certainly on the public side, between that time and through to this day. So, we IPO'd at $3.41 a share in January. In June, our lowest trade was at 21.5 cents a share. And the company had performed well. We'd exceeded all targets, forecasts, and expectations. No one had any concerns about anything that was happening operationally or financially with the business, but just the sentiment was very, very different. And so we're roughly, we're somewhere in the 80s or 90s now. So we've quadrupled off that low. And so if you have somebody who's not supernumerate, you can say we were down 93% and then went up 300%, and I think you're way ahead. And so, I recommend that strategy. But I think the big learning for us was, you do have to think about the markets in terms of talent retention, because people have equity and you just need to think about what that means when you've got the very clear mark to market. And of course in terms of capital availability. So we knew immediately upon the IPO, as I gave the speech, I was looking out towards the crowd and they were looking at the screens behind me, and they could see the price falling, I think fell 35% while I was speaking at the bell ringing ceremony. So we knew fairly quickly that we had to think very differently about capital availability and our cost profile and how we thought about growth and doing new things and so on. So there are those very practical considerations, but I think what has really stood us well as a company, and is one of the reasons I think we're in good shape today, is that was the only thing that the stock price affected. Was we thought about it very clinically, kind of for the people who needed to think about it in that strategic and financial sense, but we never talk about the stock price inside the company. I genuinely look at it on the weekends, unless there's something I need to see during the week, because I'm seeing someone who will expect me to know. I think most people in the company would be only dimly aware of it at any given point in time. And I think that's what gives you the emotional resilience to actually then sort of just keep moving one foot in front of the other. And so, yeah, that was our journey.
Awesome. So Henry has actually done something a little bit different. You've decided you're not going to IPO. So talk to us a little bit about the process of coming to that decision and why.
So I'll probably qualify that and say not yet. So that's the status quo, and I mean Jamie's pretty elegantly answered as to why not yet is probably a good answer. I think
water's fine. Come on in. It'd be great.
I mean, I think with any sort of strategic choice, you sort of start with going, your null hypothesis is you basically keep doing what you're doing, and we've found a lot of excellent strategic investors through the several rounds of, so I guess a history of our venture capital journey is we've done about 5 or 6 rounds of funding, sort of starting back in 2018. I think EVP joined the cap table in 2019, and you've invested 3 times now. Sort of $1 million raise to a $4 million raise. We closed the Series A in 2022 as a $16 million raise, and at the start of last year we brought Airtree led a $35 million Series B into Henry. And so we've been able to find quite a lot of opportunity in the private markets. And I think one advantage of that is you develop deep and long-term relationships with a core group of investors who are backing a long-term journey with you, and you are not subject to the volatilities of things way out of your control, like Jamie just described, because you're not a tradable asset, which is something happened in some other part of the world, and therefore the whole market's tanked and that's it. You know, we're obviously not marking the market on a daily or intraday basis like they are. So for us, as long as there's, and I think the maturity, particularly in the Australian private capital markets, has grown so significantly in the last 10 years that the need for us to find new capital opportunities, the need for us to even find liquidity outside the private capital markets just doesn't exist yet. Then the last part, I think, which is a really practical thing from a operational executive perspective, is the scrutiny and the reporting, the tedious reporting requirements that come with publicly being listed. I think perhaps we will get to a point where if we're adding really sophisticated late-stage investors, the marginal value of the level of scrutiny you get from them is sort of like, is it worth now going for a larger liquidity event and just IPOing anyway, because you're subject to the same degree of scrutiny either in the private or public markets. But we're certainly not there, and we're certainly not there when you have investors who are quite comfortable doing follow-on rounds, because they're basically sitting in your board meetings, they're subject to all your investor reports anyway. You're not having to do any more incremental work there. So, as far as we're concerned, unless Justin pulled something out about the board meeting this morning, I don't think we're IPOing anytime soon.
So Justin, talk to us as an investor. We've seen companies stay private for much longer than before, but obviously you are after a liquidity event at some stage. So what is your thinking on this kind of trend of companies staying private longer? Cool.
It is amazing over the last 10 years the weight of dry powder that's been raised within the space. Like that's not an interesting topic. I think everyone's aware of that. But I suppose there's been a couple of sort of tailwinds behind private market investing that almost mimics the benefits of public markets that have been referenced on the stage. So particularly an active secondary market across a lot of late-stage tech companies, fintechs, has really developed, tech-enabled, particularly in the US, where a lot of our more successful sort of outcomes actually almost act like public markets without some of the scrutiny that has been mentioned here. So we have active secondary markets in our bigger companies. There are sort of funds that specialize in those types of deals. And then there's even tech platforms, sort of think Carter in the US, where it's actually very easy to trade your position if you wanted to, hypothetically, almost like an equities trader. And so we have a couple of sort of, for example, a business called Teamworks. It's an 85 million US ARR business. They use sort of Carter as their registry provider in the US. We could this morning sell our position with no legal documentation, with a click of a button, to a buyer, and that trend has developed over the last 10 years, which has meant that it's not simply a story of how much private market capital has been raised that needs to find a home. It's also a story of sort of sophistication of an understanding of what these assets looks like, and also the development of like an almost quasi sort of secondary market that mimics what's happened in the public space, and that's really interesting. I think for us, we've now had 13, we have 47 portfolio companies, we've had 13 exits, we've sold 8 of our 11 companies in Fund 1, which was a 2016 vintage, for example. So exits have been really good for us, and to give the audience a flavour, we've sold a majority of our positions to financial sponsor-led rounds, which is basically code or lingo for US private equity folks buying our position in a business, often with a strategic platform asset, sometimes just not, as they look to our business as the platform asset. And that wasn't our expectation on the way in when we started the firm in 2015, but it's just interesting to note that, I suppose, even for institutional capital providers like ourselves, the private markets do afford you strong liquidity outcomes if you want it, and that's certainly been our experience. So we don't see an IPO or a trade sale as a requirement for liquidity. There are sort of many other ways in private markets to get liquidity, and that's really developed over the last 10 years.
Yeah, so if you were at the conference last year, I think Joseph Healy very famously said on stage that he regretted taking Judo Bank to public market. So my question for you, Jamie, is we hear about a lot of the cons of IPOing. Have there been any positive things you've seen for your company that have come out of it?
I think there are a huge number of positives to going public and being public, and again, some very real cons. But I'd say a few things. First of all, we got a significant amount of capital into the business at a time when the window was closing to do so, and we were trading off public and private options, and the public options gave us a better access to capital on better terms, and that's obviously quite significant. I think people complain that the markets are too short term, they don't understand us and so on, but actually I think the public markets are just much more direct when they kind of are telling you they don't believe your rosy J-curve projections. And I actually think if you have sort of the sort of emotional fortitude not to overreact to it, that level of clarity and directness can actually be enormously helpful. And we still report quarterly, and I like putting out quarterly numbers as a way of reminding ourselves that actually you can't just have some vague jam tomorrow, we're going to get there someday kind of plan. You actually do, the long term is a succession of short terms. And I think that clarity is helpful. And again, in the private markets, you may well have a board that plays that function perfectly as well. But I do quite like that clarity. And then the last thing I'd say is that ultimately, as a public company, although you are fully accountable to your shareholders, but those shareholders often they're not terribly idiosyncratic, and you aren't going to find that you have two kind of different investors who have a different point of view. I've heard very challenging governance stories on the private side probably more often than on the public side. And I think depending on the composition of your register, it can actually be a good foundation from which to build that company. So there are downsides and challenges to it, but I think the clarity and focus that level of transparency gives you, and the access to capital, the access to acquisition currency can be extremely helpful.
So Karen, talk to us a little bit about how you're thinking about returning liquidity to your investors, along the journey. I think that is something a lot of companies are thinking about with now. So good to get your insights into how you're thinking about that.
Yeah, so I think Justin touched on it briefly, but I think sort of building on the theme of the growing sophistication of the venture capital industry and the private capital industry just generally, not just in Australia, but around the world, and I'll touch on that second part in a sec, there's just deep specialization that's being built around, the structure of the rounds of capital. And so essentially what we've been able to do over multiple rounds is, do a partial rotation of our cap table as well. So you've got the earliest investors, sort of from an angel round coming out of Wellington, which is where Henry was founded. They, in Series A, Series B, have been able to sell down a lot of their position and realize a significant return on an investment, but also their investment mandate is to then invest in early seed stage businesses coming out of New Zealand. And so Henry is no longer an early seed stage business, so having their capital tied up in Henry is actually sort of outside their fund mandate as well, and that's quite clear. The other thing is also, I think, as Australia's position has grown as a really high quality market for global capital to come to, we've been able to attract overseas investors as well. So our Series A was led by a company called Left Lane Capital out of New York. They followed on in our Series B as well. And that also gives us a lot of credibility in terms of us now going, okay, if we choose to do a Series C at some point, hopefully it'll be a larger raise, and perhaps we'll need to look offshore for that, but then having the access of Left Lane's networks, but also the brand credibility that comes with going, yes, we're an ANZ domiciled business, but we have US investors in our cap table. All of a sudden you've got global investment firms going, well, I'm interested in them just by virtue of the fact that Left Lane's on their cap table, whereas they may not be as familiar, although they should be, with EVP and Airtree. They just won't necessarily be. So I think because we've been able to do that, we're reasonably confident that we can continue that. And then the obvious second thing is what Justin said, is that there is always the option around the secondary capital markets, which are just becoming more and more mature. So we're reasonably confident that we can continue to find liquidity for our investors. I think an IPO is clearly a more direct way to do it. But notwithstanding the very positive things you just said about it, we still sit in the bank that currently the management overhead that comes with the scrutiny is probably not, the juice is not worth the squeeze yet.
So Justin, you mentioned the inherent risk of companies IPOing too early. So what is too early, and what in your mind, what makes a perfect company that should look at IPO?
Sure. I think there are various rules of thumb. So, we typically coach our businesses. You really want to be north of 100 million of ARR to get this sort of post IPO sort of support, if you like. Clearly, that's not for everyone, and there's different paths, of course. But that's typically a bit of a framework that we apply. I'd say that, we just don't feel like, firstly, this might sound counterintuitive for a VC investor to say, but we often tell people, or our core belief is that a requirement for capital is a last resort, and if there's a way to build your business and sort of optimize for an outcome without the need for capital, whether private or public, that is first prize. And obviously that comes with there's a sort of a trade-off there on growth and sort of obviously certain business models don't allow for that, but I think we come from that lens, and that's the sort of belief that we bring to the businesses we work with. And so as a result of that, if you do need capital, often the public markets, in our view, is not a good home for sort of entrepreneurs who are typically making sort of fairly long-dated, often asymmetric type decisions, where the payoff from a lot of these decisions can come in a long period of time. And to Bronwyn's point about the J-curve, that can be very deep for an early stage business that's a high growth company. And I think everyone understands this, but like the rational thing for sort of often loss making high growth technology companies would be to lose more money hand over fist because of a belief in the unit economics that over time on a sort of per unit basis, it's actually a very profitable business, not by accounting standards, but on a per customer basis. Think Xero, the accounting software platform, Spotify, those types of models where you pay an upfront sort of customer acquisition costs, and then you recoup that spend over a period of time. And so I think putting all that together, a bit of a confluence, if there is a need for capital, it sort of strikes us that for early stage businesses that are sort of making those types of decisions and running that playbook, private markets can be a much happier home without the scrutiny, to Karen's point, of sort of quarterly reporting, but less about the overhead and the scrutiny and more about optimizing for longer term decisions, which might be really challenging in a public market environment where you have a sort of a daily reminder of the scorecard, and really the rational sort of economic first principles thing to do would be to optimize for a much longer term opportunity, and that's certainly how we work with a lot of our companies to optimize. So I think we look for a level of sophistication. We've had a business called SiteMinder. We were the first investor in 2012, and sort of that business sort of IPO'd at around about the 100 million ARR mark, and that seems to be of a scale that it can sort of have the stability, predictability of its revenue line to warrant the boards.
If I can just jump in a couple of things that Justin said. So I'd absolutely agree that if you are going to get knocked off kilter by volatility in your share price, the public markets are not for you. It doesn't matter how great your company is, how successful it is. You could have gone up 50-fold in 2 years, but if there's then a 10% drawdown just because, if that's going to distract you and keep you from building a great company, it's just not where you should be personally. And that's not a judgment. It just I've seen so many small public companies get knocked off course. And then I'd also agree with what you said in terms of access to capital. So the public markets, an investor will have many positions. They have high cognitive load. The amount of time they spend on each investment is not very high. They often don't have direct access to management. And as a result, public markets are really not interested in your story. Right? When we first went public, and I was explaining what we did and kind of the path to profitability, there was a lot of, and then you can see this line is going this way, so when it crosses this, and then you'll notice that this is coming down, so you take they do not want to hear it. They're not interested. They're not going to, understandably, really take the time to decide whether they believe that or not. They've got, public market investors are successful off their ability to quickly process a large number of opportunities, and so they're attracted to things that fit a fairly predictable, understandable mold of profitability and growth. So if you are going to need capital, you only want to do that from the public markets. IPO is a little bit different. People will pay attention then, but especially after that, you only want to be in the public markets when you are a simple enough story for them to quickly grasp and be happy with. And so I wouldn't go public before that. If you don't need capital, then I guess why are you doing anything at all? So I think that is a really good point, that you want to get to that level of maturity in your business model, which we certainly were not before you're a natural fit for the public markets.
Or selling burritos, maybe, I don't know. But what about, we've seen less companies IPO, over a period of time. Do we think that's the new norm, or do you think we're going to see the IPO door bust open? This is a question for anyone in the panel who wants to answer.
I think it could be a new norm. I'd be extremely surprised if the level of activity in that part of the world sustains for the next couple of years. It's at absolute record lows, but the rounds done by businesses like Stripe, we didn't have rounds like that back in the day, and particularly secondary-led rounds where it's effectively a liquidity for employees. So some of the rationale for an IPO has diminished a little bit over time. But I think there are now, particularly from an Australian context, enough businesses of scale, significant enough. There's about 2,400 companies that have raised seed or Series A financing in the last 10 years in Australia. And not all of those companies, but certainly probably the top 10%, could now realistically IPO if they wished. And, certainly our view is that, IPOs will increase by quantum over the next few years. Hard to know if it's going to get back to where we were in sort of 2020, 2021, but the record lows of the last 2 years probably won't sustain.
I think there's probably also a question there around which exchange do you list on as well. And I think the competition between exchanges, but also I know the ASX has been distracted a little bit by some other issues more recently. So the brand and value proposition of the ASX is a little bit different. But obviously we've seen the success of Australian companies in the US on the NASDAQ, particularly Atlassian being chief of those success stories. So I think that's a really interesting opportunity which perhaps didn't exist 15, 20 years ago, where there is this globalization of Australian companies who are choosing then to go, actually, we feel like more sophisticated investors live in other markets who are able to see some of the long-term bets and will prop up our valuation better than perhaps ASX investors would. And so they're choosing to go down that path. I think Canva perhaps will go down that route as well. And so, you know, one question is IPO, but the other question is like where to IPO as well, which I think is a whole other perhaps panel, but definitely a whole other set of considerations as well.
We touched on the secondary market a little bit, so interesting to put on our future goggles and see where that's heading in Australia. It's still something very new here. We've only had our a dedicated secondary fund, I think, for the last 2 years in Australia in that second quarter. So we're still in the early stages of that maturing. Keen to know where we see that heading in Australia.
We certainly think it's the biggest opportunity for private market technology investing. We've launched a new fund recently that has a secondaries focus as a result. And, my earlier comment about the 2,500 companies that have raised Series A financing or seed and Series A, it's not just the founders or the early shareholders that need liquidity, it's employees within the ESOP, it's lots of stakeholders around those businesses that are sort of getting to, end of fund life issues, they're just long in the tooth generally. And so I think there is going to be sort of an unbelievable trade in the next short term. Like a lot of the early Australian VC vintages were 2014 vintages, so they're like rapidly approaching end of fund life constraints. And we certainly see a lot of those businesses as very high quality company, and the requirement for liquidity from their investor base actually doesn't have any reflection on the quality of the asset. They just reflect sort of structural challenges with their own mandates or their own sort of hold periods. And so we certainly see that's a big opportunity. As you say, we're a long way behind what's going on in the US, sort of with platforms such as Carter that sort of facilitates and provides the rails to do those types of trades. But I think, not just in the big end of town, not just like the Canvas of the world, there's going to be real liquidity sort of opportunities, secondary led rounds across all of those companies, certainly domestically. So yeah, it's a really big opportunity.
And I think just to add to that, if we look at offshore as what's happening, what's likely to be in Australia in the coming years, the markets are actually starting to resemble each other much more. So clearly the private market's becoming much more deeper and much more liquid, but also a number of U.S. investors talk to us and say, well, of course, no, listing, that's no problem. We can do a private investment in public equity, and we do it like this. So actually, I think, in addition to the sophistication in the private markets and the ability to kind of have that secondary liquidity, it's now also starting to go the other way a little bit, where even though you're listed in a public company, you still actually are very much in frame for a number of the larger and more sophisticated private market investors.
Just very quickly on that point, I think it's actually really happy hunting ground for a more sophisticated investment market, because if you remove the liquidity constraint, which is not a trivial thing, I'll say, but if you remove that, then actually you've got access to a whole wealth of data around the trading history of that company. Because if you're thinking Series B, Series C, Series D, they've been around for a number of years. You've got access to all those reports. But you've also got essentially an investment arbitrage opportunity, because you're not competing with everyone with homogenous information in the public markets. So I think astute investors would look at secondary investing and late-stage private capital investing going, this is a supremely attractive area for us to get into if we're not into it already.
Of course, there's differentiation, and it's an important one, though, is capital in secondaries doesn't come back to the companies. So, that's also something that, kind of adds complexity to that.
Yeah, and we're seeing, for example, sort of GP-led secondaries, which is effectively we're being approached by a lot of largely overseas investors to buy positions in our fund, for example, where they say to us, you can return back 50% of capital back to your LP base, and effectively you can do a neat switch on the cap table, and it's a structuring nightmare. But so I think, to your point, there's lots of different shades of secondaries and lots of sort of different types of these transactions. But yes, ultimately they need to be in businesses that don't have a requirement for primary capital. Like, to give you a flavour, like the deal we're looking at the moment, it's a 10 million ARR business. 2 existing investors have sort of extreme end of fund life issues on their register, and we can sort of position to the founder to provide a small lick of primary capital at reasonably attractive terms, very fair valuation to support their growth journey, and then we can provide a win to the existing 2 VC funds that need to find liquidity at very attractive, deeply discounted sort of minority position, which is obviously attractive for us as the incoming investor. And then the company actually gets like 20 to 25 of its register with a new investor, new lease of life, longer sort of new fund mandate, and hopefully active support. So you can really structure these things to be like a win-win-win across all those stakeholders if you get it right.
Awesome. That's all we've got time for. So thank you to my panellists, Jamie, Karen and Justin. Thanks, everyone.